So the theme that we have for this quarterly review is the metaphor of the teeter-totter. And I'm going to talk about this a little bit later when it comes to bond prices and bond yields, and then also a relationship between interest rates and the price to earnings ratio for stocks. So first, let's begin with market overview, as is our custom in these quarterly reviews. These charts come from the week ending up the previous week ending on the 21st, last Friday. And here are some major indexes where we see the return, the year-to-date returns, and the week change for last week. So you can see last week we did have a big rally here. Some people might call that a bear market rally. Time will tell. Hindsight's always more perfect when we look in the rearview mirror. So right now we've had a good a rally here after some significant downside. So you can see the S&P 500 year to date is down just over 21%, and the Dow Industrials, which is an index of 30 stocks, is down about 14.5%, and the tech heavy NASDAQ is down more than 30%. The Russell 2000, which is mostly small cap stocks, is down about 22.5%, and the Euro Stock Index, which is a somewhat similar to the Dow Industrials, is an index of 50 European blue chip companies, is down almost 19%. And the Shanghai Composite, which is the Chinese market, is down about 16.5%. And then some mixed signals out of China about their GDP growth. That they've been suffering with the pandemic, of course, and their zero COVID policy. And then the MSCI ACWI, that's the All Country World Index, which is a good representation of all of the investable universe of publicly traded companies, is down about 25.5%. And this chart shows the trailing 180 days performance of the S&P 500 index, which gets a lot of attention in the business media. This is kind of the standard index that a lot of the business press uses to talk about the overall stock market. And you can see it's been kind of choppy. You know, we started out this year with an all-time high, and we've had rates getting raised and a lot of uncertainty, of course, with Russia invading Ukraine, having a major war in Europe that hasn't really happened since World War II. And remaining supply chain disruptions, not only related to Russia's invasion of Ukraine, but we still are in a low to mid-level trade war, I would call it, with China. And just recently, President Biden announced that the U.S. is going to put a damper on exporting any technology related to the really fancy superconducting chips that would go to China for really very highly technically oriented applications that could be going into military applications, which we would want to prevent that. And let's look at the performance by economic sector. We'd like to point out the fact that, you know, that energy has done very well. And you can see energy again last week was the outperformer. The year-to-date change for energy is almost 58%, and last week was 8%. Oil prices remain elevated. Natural gas prices, everything related to the energy complex is doing pretty well. It's not fun to pay those higher bills, but as an investment, energy has done very well this year. Look at information technology. That's 26.4% of the S&P, and that's down almost 29% for the year. So you think in your Apples and your Microsofts and those big, huge mega cap tech companies. And this chart shows the relationship between the S&P 500 and the MSCI EAFE, that is Europe, Australasia, and the Far East, essentially a lot of the other developed world and some emerging markets. So when this number goes up, that means the prices of international stocks as the denominator are lower than the numerator in the S&P 500. So this is a way to see the value comparison between international stocks and the S&P 500, which those companies that are domiciled here in the United States, but have international business, of course. This shows you relatively a valuation between those stock prices. So when this chart goes higher, like it is right now, that's saying that relatively speaking, US stocks, even though we've seen dramatic declines, are still performing better than their counterparts in the rest of the world. But that also means that international stocks are very attractively valued right now because they've dropped more dramatically than US stocks. And then, as we all know, that the Fed keeps hiking rates in an attempt to get inflation under control. So here's the 10-year Treasury yield, the trailing 180 days. And you can see the line has just gone up and up and up since the summer. The Fed keeps raising rates. We're due for another 75 basis point increase. And then we're thinking they're telegraphing maybe another 75 or 50 after that. Inflation gets a lot of attention, and rightly so. We're all experiencing the pressure from inflation, and we hear about the consumer price index. And there's kind of the headline number, which you can see in the orange line, and then the core CPI. And I like this chart because this shows the month-to-month change. And the headline number that's usually reported is the year-over-year number. So when they come in with inflation, it says, oh, inflation was 8.1% or whatever it might be for that month. That's year over year. So that's compared to the same month of last year. What this chart shows is the month-to-month change. You can see in the middle there, 0.6% change. And if you compound that over 12 months, that's about 7.4%. So the yellow line here is the core CPI, and that measures the changes in the price of goods and services that excludes food and energy. So the headline number might be more volatile. It's interesting here, when you look at this, you can see the orange number, and you may remember President Biden kind of riffing on this a little bit in the summer. You see how that orange line went down to 0 in the summer, and you remember how proud President Biden was of inflation is essentially 0 now. And what he was talking about was this chart that you see. So back in the summer, he could rightfully say, well, month to month, the headline number, the CPI number, did not go up. And then the following month, it just went up like 0.1% month to month. And then, of course, just recently, we got another substantial increase. But the core number seems to be flattening out in its rate of increase, which is a good sign. And we'll see as the data comes in if the Fed's raising rates is going to have the desired impact. This is the VIX index, which is the so-called the fear gauge. This is the Chicago Board Options Exchange Volatility Index, which is a measure of the S&P 500's index options. And we usually refer to this as the fear gauge or the fear index. And so when the number goes higher, that means there's more volatility in the market setting prices, and options reflects how traders are viewing the impending future of stock prices. So when the gauge goes up like this, it means there's more uncertainty and there's more volatility, more ups and downs in the market. And we've seen that recently. We had a great rally into August, and then we went right back down. And then now this month, we've come back up a little bit again. So the market has been very volatile. Nothing surprising there. Now I want to talk a little bit about how we put all of this into perspective. You know, how can we understand what is really going on right now? And right now, you probably hear that nasty R word a lot in the news, recession. And it seems that more and more commentators and forecasters and economists, and they're talking about recession. And it's a midterm election year, so there are those that want to scare everybody about we're in a recession or heading into a recession or whatever the case may be. It seems to be more likely than not, I think, at this point, that we are entering a recession, currently in a recession, but how long will it last? We don't know. The odd thing is that we kind of want some kind of a recession to put a damper on inflation, because inflation is a much bigger threat to the economy than a recession is. So in my letter that I shared this afternoon, I just want to make 3 points: that recessions are an unavoidable part of our economic system. Recessions are temporary. They don't last long, typically, compared to periods of growth. And recessions are counterintuitively great times to invest because stock prices are lower. Now, this image, I shared this because I think it captures well how we're going through this current market right now. These teeter-totters, one's going this way, two are going this way, the other one's going this way. There's a lot of people trying to figure out, reading the data, which way are we going? Are we going to find a bottom here? Are we going to smooth out? Are we going to stop being so volatile? Time will tell. But right now, we kind of feel like we are on a teeter-totter, and we're going up and down with all the different data. And earnings look good, and then some companies do better than others, and inflation and the war and supply chains in China and all this, the politics. It's all a lot of noise, I think. So I want to paint for you a picture, I think, that will help us understand why we're in the current environment that we're in and how we're going to come out of it. You may be familiar with what is called the bond teeter-totter. And that is, this very simple diagram here explains that when interest rates go up, bond prices go down. So even if you're conservatively invested in bonds, especially longer term bonds, well, your portfolio is going down because the market, when they trade the longer term bonds, they're going to want lower prices to get more yield out of those bonds that already exist. So if you owned say a 10 or 20-year bond that pays 2%, but then newer short-term bonds are paying 4%, well, the market isn't going to want to pay you a higher price for your 2% bond. It's going to want to pay you a lower price to get a better yield out of it. So it's a very simple concept that when rates go up, the bond prices go down, which makes the value of the prices go down. And any mutual funds or investments that have bond in there, you might be getting more yield with the shorter term duration or intermediate term duration bonds, but the prices are going down, and then eventually it stabilizes. But that explains some of the downward pressure that we've had in portfolio values. Now, there's another teeter-totter that I want to suggest to you in a relationship that's kind of like a teeter-totter, and that is a relationship between interest rates and the price to earning ratios of stocks. And in my letter, I highlighted a couple of paragraphs from this gentleman, Michael Smolyansky, who's a senior economist at the Federal Reserve. In his note of September 6th of this year, he talks a lot about a lot of the research that he's done recently to explain the relationship between how stocks have really performed very well and valuations have been very rich for the last 20 years because we've cut corporate taxes and rates have been very low. And he says early on in this note, over the past 2 decades, the corporate profits of stock market listed firms have been substantially boosted by declining interest rate expenses and lower corporate taxes. Remember, at the end of 2017, the Republicans and President Trump passed that law, the Tax Cut and Jobs Act, I think it was called, that reduced the corporate rate from, I think it was 35% to 21%. That's a dramatic decline for corporate taxes. This note's key finding is that the reduction in interest and tax expenses is responsible for a full 1/3 of all profit growth. I want to emphasize that profit growth for S&P 500 non-financial firms over the prior 2-decade period. So what he's saying is is that 1/3 of all profit growth of the S&P 500, non-financials, because those are more tied to interest rates, has been due to the lower corporate taxes and the low interest rates. For so many years, we had virtually, the Fed rate was virtually zero or below 1% because of after the dot-com bubble burst and the subprime induced crisis of 08-09, and then the pandemic when rates just went to zero. All of that was an abnormal in the long frame, the long term of history. That was kind of an abnormal stimulus, having those low rates. And this gentleman says, well, that accounted for about 1/3 of all the growth. So when rates go up, as they are now, they're going more back to a normal state of affairs. And here you can see a chart from the mid 1990s through today of the 20-year Treasury rate. And you can see the average during this time period is 4.36%. And as of yesterday, the 20-year Treasury closed at 4.38%. So instead of the 20-year Treasury being at 2% or 1.8 or wherever it was not long ago, now it's basically back to the average for the past almost 30 years. So now that rates have gone up, it's pushing the teeter-totter up on that side, which makes the PE ratios come down, which means stocks are getting cheaper. Here's a chart from January 1st of 1990 through yesterday. And what I did is I just charted the monthly average PE ratio for the S&P 500. So that's the price of the stocks versus their earnings. And then I put a black line in there that is the rolling 5-year average PE. And you can see right now for this time period since 1990, this is kind of more in the time frame we're used to. We've had the lower rates and lower dividend yields compared to the long time frame, historically speaking, for stocks. That for this time frame, average PE is 24.5. Well, today it's about just under 19. So we're already below the average for the last 30 plus years on the PE ratio. And you can see the blue line there toward the end of this chart is dipped below the rolling 5-year average. So it's painful when stock prices go down like this. But the good news is that stocks look very attractively valued. So now is the time to really stay the course. And if there's any new money to be invested, it's a good time to invest for the long term. I love this chart. I've seen this in various formats over the years, and I think we've shared this one before. This really applies to those of us who might dabble in investing in individual stocks. And it's kind of the emotional roller coaster. It shows us why it's so important to stay invested and to remain diversified. And I love this, like when the stock goes up or an index goes up, right at that maximum point of risk, when it's at we're feeling so ebullient and we're like, oh, this is great. Look at all the money I made. And it starts going down a little bit. We think, well, it's a small setback. I could always invest more, and it goes down more. Well, it can't go any lower. Oh no, I'll sell out now and I'll make a little bit of money after, and then it goes down even more, and then I just completely get out. And then right when you do that, that's typically the time when the market starts turning around. As you say, oh, you pat yourself on the back. Oh, I told you so, good thing I got out when I did. And then things start improving and going up. Wait a minute, and it keeps going up, seriously, and you didn't buy back in. That's the catch. If you're going to time the market, you have to be right twice. And it's really, really, really hard to do that. That's why it's so important to be extremely diversified and just stay the course so you avoid this trap of getting out at the wrong time. Here's why you don't want to get out. This is a graph of the compounded GDP growth from 1950 through 2019, before we had the last very brief recession when the pandemic hit. So this big, huge mountains you see in purple there are the compounded GDP growth from 1950. And those little red blips you see in the bottom, those are the recessions. So the average economic expansion during this time frame occurred for 67 months, and GDP growth grew 24.3%. Of course, stocks would grow much more than that. And then the average recession lasts 11 months, and GDP goes down 1.8% on average. So this is a very, I think, intense way to show you that it's very important to stay invested, because if you get out, things can turn around fairly quickly. And then, you know, if you don't get back in, well, you can miss that big, huge purple mountain that you see here with your investments. I resurrected a slide from, I think this was April or May 1st, I think, of 2020, when we had the waterfall decline because of the pandemic shutdowns, and there was a ton of uncertainty, and the market had crashed, you know, 35% or something like that in just the 2-3 weeks. And Jim and I did a presentation of talking about weathering the storms. And I thought I would share this with you again to show you why it's so important to stay the course and remain diversified. Look at the 5-year rolling average. If you're just in stocks, the worst 5-year rolling average you had was a -3% each year. That's a big deal. So 5 years of -3% each year, that's a big deal. But the best 5-year rolling average is 28%. That's amazing of compounded annual growth. And the 20-year, the lowest return you would ever get in the 20-year rolling average in stocks is 6%, which is pretty good. In the 50-50 bond to stock portfolio, you can see the worst 20 years you ever had was 5%. And the best you ever had was 14% for 20 years. That's pretty amazing. So this chart shows you how in the short term, yeah, you can have volatility. Look at the 1 year. Well, you had a really bad year. That was probably the 08-09 year, down 39%. But then the greatest year was up 47%. And here's how we do it. I think you're all familiar with this as we share it in our materials, that our models invest in the same underlying 7 portfolio strategies in these 3 different asset allocations, with moderate being the most popular one. For most churches are in the moderate version, which is 60% stocks and 40% bonds. And so as bonds and stocks do their thing in a normal environment, they're kind of non-correlated. So bonds might be buffering or helping the portfolios to stay somewhat consistent. As I mentioned before with the bond teeter-totter, bond prices have also gone down as stock prices have gone down, but that won't last forever. And I think we're probably starting to find an equilibrium here, as the Fed will probably start relaxing its rate increases into next year. We'll see how it goes. Hopefully inflation gets under control and things can kind of get back to normal. Here's the performance through yesterday for the portfolios. You know, it's ugly. If you look at the trailing 1 year, for example, on the aggressive model, so over the past year, it's down 18.5%, which just happens to be exactly on its blended benchmark. But if you look at even just the last 3 years, if you're in the aggressive model, you annualize 4.35%, and the 5 years, you annualize 5.5%. Even with a huge 18.5% decline like that over the 3 and 5 years from this point, you're still doing pretty well. We remain, for the most part, over the longer time frames, beating the benchmarks. The conservative model tilts toward higher quality and government bonds, so that has kind of underperformed a little bit, but has still done very well.